How's it going? Welcome to Everything Investing. Today we'll be kicking off this quarter's earnings season with Adobe, who just reported earnings, and we can immediately see a 5% increase in the stock price after hours, indicating a strong quarter and outlook for Adobe. We are now sitting at a market cap of 152 billion, a PE of 32, and a price to free cash flow ratio of about 4%. And although we saw a bounce in today's stock price, we can't rely on Wall Street to tell us when to buy businesses. So we have to do our own analysis on the business in order to determine whether or not this is a buying opportunity after all, considering the stock is actually down about 41% year to date. And if so, at what price we would consider this to be a value buy. So make sure to stick around as we'll be answering all those questions and more on today's episode, as we'll be starting with a full analysis into the financials. We'll go through the top line, bottom line, balance sheet, cash flows, business overview, and finally we'll conclude with an evaluation of this business using our intrinsic value calculator. And if you enjoy this type of content, make sure to subscribe, as we post on here regularly during the earnings season, looking in depth on the businesses that you are most interested in. So always make sure to post the businesses you want to see next in our videos, and also make sure to leave a like and subscribe, as it really helps out the channel. But without further ado, let's jump into the analysis of Adobe. And as of today, December 15th, they've reported their Q4 earnings. If we take a glance at the Q4 results, they reported about $4.5 billion in revenue for this quarter. That's 10% year over year growth, and on a constant currency perspective, 14% year over year growth. Earnings came out to be about $2.50. And if we take a look at a yearly perspective, altogether for the year, $17 billion in revenue, 15% constant currency growth. So we're seeing growth across this business, even despite the current economic conditions, where you might expect this business could struggle considering consumer spending has tightened a bit, but they're still seeing record revenues here. And if we want to analyze the different segments of this business, we can see here core revenues come from their digital media segment, where we have $12.8 billion in revenue. Again, 16% year over year growth on a constant currency perspective. Their other segments here, digital experience, advertising, things like that, they are also up about the same. So good growth considering the stock is down over 40% on a year to date basis. And if we compare this to the S&P 500, we can also see this is also down about 18% year to date, which just goes to show that at least in North America, we have seen slowdowns, but a business like Adobe is still growing at relatively strong growth rates. If we wanted to break this down further, we can look at their revenue by geography. And shout out to this video sponsor, Main Street Financial Data, where you will see these beautiful charts on our videos going forward that really help us investors break down some key financial data. And as you can see, about 60% of the revenues do come from the Americas, with the remainder coming from Europe and Asia. And when we take a look at the core revenues here, we can really see the growth that this business has had over the past few years, indicating the strength behind this business. And this is something we really want to look out for, especially a business that can operate at these kind of levels during times when a lot of businesses, and including the market, they're all down. We're seeing strong fundamental growth. All right, so from a year-ended perspective, we have $17.6 billion in revenue. Their cost of revenue is made up of subscription, product, and services costs, only about $2 billion worth of costs. And so they're left with $15 billion of gross profits, super strong margins. And we can see that they are investing heavily into research and development, as well as sales and marketing. And that ultimately leaves them with about $6 billion in operating income. Again, taking a look at their operating expense breakdown from these charts from Main Street Financial Data, the first link in the description down below, we can really see, again, they are spending majority of their expenses on sales and marketing. They're really trying to push their business out. And to be fair, their business is growing as a result of that. And they've been able to maintain these high gross profit margins for quite some time, and they're very stable up in the mid 80s. But of course, because they are spending on growing the business, they want that growth to remain in the at least mid teens. They do have about 30 to 40% operating profit margins, which is actually quite strong when we compare this to other businesses like even Amazon, which only has about 5%. In terms of liquidity, there is no problem here. Very strong liquidity position historically, as they have an asset heavy business compared to their liabilities. Finally, that leads us to what they do with the free cash flows that they do produce. And as you can see here, they're spending their leftover cash to reward shareholders by buying the stock while it is down 41% year to date. So if that's something that interests you, That's what Adobe is committed to. And when it comes to their outlook, this is what they're saying. They're saying they should be able to produce about $19 billion in revenue going forward for next year, and that earnings should come in at about $11 per share. And if we use this chart from Main Street Financial, we can really illustrate what this means for the business. We can see operating income has been able to grow recently. And so if we compare that to their revenues here and estimate that they're going to come in with about $19 billion in revenues by the end of the year, we can estimate that their operating income should come in at about that $6 to $8 billion price range. So if we enter that into our calculator here, we require a 10% return. They're not currently paying a dividend, and we expect that at a 15% growth rate for the first 5 years, that would drop down to about a 10% growth rate for the 5 to 10 years after that. On a 32 PE like they're currently trading at, this stock should be worth about $601 in a normal economic scenario. That's almost a double from where we are right now. Now, in the very best case scenario where we see further growth, less consumer tightening, we see rates get cut, things like that, this business, if we estimate that they can grow at, let's say, just 18% for the first 5 years, that stays constant at about 15% for the 5 to 10 years after that. On a 35 PE, the stock should be worth almost $900 per share. Again, massive upside here. Now, in the very worst case scenario where the effects of a recession really tank the market, we see even more consumer tightening, higher levels of interest rates, the business is impacted by competition, things like that. They're only able to grow at, let's just say, 8% for the first 5 years. That drops down to 4% on, let's just call it a 30 PE. The stock should still be worth about $329 per share. That's exactly where they are right now. And that's in our worst case scenario. If we were to drop this down a bit further, let's say they could only grow at like 4%, then they'd only be worth about $272 in the very worst case scenario. And we'd still have a little bit of downside until we met that level. But with the business they have, with the customer retention ratio that they do have, and being able to grow their business even throughout a pandemic and a rising interest rate environment, this may be a great buying opportunity for this business. We're already back down to those 2019, 2020 levels right now. So we've given back all those gains from the pandemic, but this may just be that buying opportunity again, that once the economy unlocks, interest rates start to fall, consumers start to spend more, as we did over the past decade, we can really see a benefit in this stock because we know people are going to be using their services more. They're not going to feel like using cheaper alternatives. And so this might be the stock that you want to own. Again, I can't provide any financial advice, but let me know your thoughts in the comment box below. And again, make sure to check out our video sponsor, mainstreetfinancialdata.com. Again, first link in the description. Also, make sure to smash that like button, subscribe, and I'll catch you on the next one.